The purpose of this group is to put people in a room together that would normally never be in a room together.
I used to shy away from the property manager. I learned that when you get up to a certain number of units.
Wow, that was a good feeling. So I think that was 2012, 2013.
There are investors who are my clients that haven't even bought it yet.
We almost ready, but I just want to say Happy New Year to everybody. Congratulations on everybody's success from last year. We want 10x our success from 2023, and I think this is the room to do it. And the guest that we have today, good brother Michael Johnston, is probably one of the best people to learn how to do it. A lot of times I call Mike just for a quick 5-minute conversation, and it ends up being a 1-hour TED Talk. So I'm very grateful for all the wisdom that he has built up on the inside. He has a lot of experiences, a lot of bumps and bruises, but a lot of successes, right? So today we want to kind of talk about those successes, we want to talk about those mistakes, and we also want to talk about exactly how he's swimming in the waters in the temperature that we're in right now in this brand new climate, okay? So you've been there before, but it's your first time as a guest, so I want everybody to give them a loud Westbank Real Estate Investors clap. We're going live. Everybody get loud. So it's probably going to be a real advanced conversation, but still I want to ask the basic. How did you get started in the business? Because somebody in the room has a similar background, and we just want them to see that you can start from where you start from. So how did you even get in the real estate business?
So for me, I always was interested in real estate, but what probably drove me there was what happened back in 2005 when Hurricane Katrina came and drove me away from the city. I was looking for a way to get back. I lost everything that I had, my home, belongings, everything. I was reduced to nothing. And by education, I'm a physical therapist. So I was working with PT, but I wanted to come back home. And so I made it back home after doing some insurance adjusting in Florida and just odd stuff just to make it back so I could go live in a FEMA trailer. But it was, I was like, how can I rebuild my life and do some things? And I thought real estate, would be the way. I'll tell you that my first swing at it, I wasn't successful. I did an old Carlton Sheets kind of, no money down program and learned just enough to get myself in trouble, right? That was right around 2006 going into 2007. And if you guys who are old enough and were still kind of playing around with it, might remember what happened right around 2008, collapse. Well, guess what? After losing everything that I had, because of a storm, I got myself into a different kind of storm and had to wind up giving back properties. It was hurtful to me because the way I got into it, I had some people that are near and dear to me attached to it, and so I affected them in a negative way. I got out of real estate, licking my wounds, and thinking about, what did you do wrong? Is it that real estate doesn't work, or was it you? And so after being afraid for a while, I thought about it and I said, you know what? You didn't get enough information. Your knowledge wasn't complete enough to move forward. You jumped in before you really knew what you needed to know. And so it was in 2012 that I got more complete information. There's some of you in here. I know my boy Jay Alexander sitting out there. We went through some training, together through this, educational program, and it gave me enough information to feel comfortable enough to get started. And so that's what got me on my way.
Yeah. So what information did you pick up from that particular training versus the Carlton Sheets that was a game changer for you? What was different?
So I learned how to basically value real estate. I learned the idea of what leverage point, loan to value, not to exceed, basically where to walk away and what was a deal and what wasn't a deal. Times were different back then as far as New Orleans is concerned. You had a lot of flooded, gutted, damaged property around the city. And as I know Emile's aware in my bio, my father, I grew up around construction. So my father has 60 plus years of construction. And at 12 years old of, stepping on roofs, stepping on nails, and basically breaking something by the end of the day, he said, son, stay in school. That's not for you, right? So I decided that I could be involved in real estate or construction, but not on the hammer and nail side of it, right? So by me learning my numbers, by learning, what point of leverage not the past and how to put deals together, I focused more on the numbers. And so I became more of the business side of things and just, grew into being better at organizing crews. But it was me being around construction and real estate growing up that, that interest always existed. But going through that education kind of brought it all together for me.
Gotcha. So what about the numbers you learned that's more important that maybe some people might overlook? So we know loan to value, we know sales price, we know our itemized costs, but what numbers kind of stick out to you to make sure that this is the deal I'm gonna pull the trigger on?
Right, so me answering that question probably a year or two ago versus where I sit today, I would give you some more textbook or training type answers of talking about max allowable offer, predicated on what your budget is and what it will appraise for and all of that kind of stuff. That's a big part of it, but I will tell you where things have evolved more recently, we've been in a very favorable interest environment probably for the majority of years that most of you in here have been maybe dealing with real estate. I know there's some that have been here maybe when it wasn't favorable. I'm looking at David. He probably can tell stories of, when not or whatever. But it's been very favorable, and even if you have the right education, knowing your numbers, max allowable, all the other things that a lot of you guys already know, if you had that down, it was more like kind of fishing in a barrel, right? Your chances of succeeding was far greater, okay? A lot of people were being successful in real estate. And so if I'm honest in answering it as I sit here today, there are different things that I'm considering, because we now are in an environment where interest rates are rising. Things are inflationary. We're coming off a time where labor costs, material costs, everything higher. So depending on where you are with it, right? If you're a wholesaler, there's gonna be a different pain point for you, because you're probably gonna see some deals start to slow down because the rehabbers, renovators, they're a little bit more uncertain right now because they're not really knowing where that exit is. And I'll explain that to you a little bit more, right? Where I'm a build, hold, renovate, hold type of investor, developer. My whole goal is to maximize and build AUM, assets under management. If you have a formula that works where if you're in it for, call it 70, 75% loan to value, your debt service coverage ratio is 1 point whatever, you're checking the boxes there, then you say that it's gonna yield this amount of money. The game is changing because you could run those numbers based off of a 5% interest rate, maybe 6% interest rate. Now, depending on where your lender is and where you're gonna fall, you're talking about maybe 8% or higher. And so everything kind of changes there. We just received news at the end of the year. We know Citizens has increased their premiums. They've gotten the go-ahead to increase their premiums as of 2023 by 63%.
For the people that don't know, or the people that's not in Louisiana, what is Citizens and why is that statistic important?
So Citizens is basically the state insurer, right? There's Citizens of Florida, there's Louisiana Citizens, Fair Plan, all of that stuff. What we know has happened in our area because of the hurricanes and the weather patterns, you know, all of the other, most all of the other insurance companies have gotten skittish. A number of them pulled out last year, leaving us only the guaranteed insurance company for us, which is Citizens. It's the state fair plan, right? And so now that they've picked up all of these policies, they petitioned the insurance commissioner, I guess, or whatever, for a rate increase, and they were approved to increase their premiums by 63%. So when you look at your cost to operate these properties, just the cost you can't get around, you know, insurance is one of them. And what happens, people start trying to skimp. And I witnessed this way back when I was in Florida years ago. They start trying to get a cheaper, more affordable premium. So what they do is they increase deductibles. Rather than maybe having a 2% wind deductible, they raise it to 5%. And it becomes like a Russian roulette. I mean, will I dodge a storm this year, or will I have to file a claim? There's a big difference on a 2% deductible versus a 5% deductible. You know, I'll tell you, you know, right now what I'm dealing with. Normally, I've been the kind of person, I don't use insurance unless I absolutely have to. Shingles blow off my roof, whatever like that, I'll make the basic repairs, I keep on going. Unfortunately, about a month ago, I was one of those unlucky, you know, individuals that was affected when the tornado blew through. I own an apartment building in Gretna, not too far from here, and my phone started blowing up like crazy. And you know, Mr. Mike, the roof is off. I said, the roof? Oh my goodness! And I'm just sitting there like, it was like surreal, right? And the images started coming in. The roof was laying across the street and all this stuff. Rain entering the building. I'm like, oh boy, here we go, right? So let me tell you, while you're winning, this game can be incredibly fun, right? It's almost like being the boss of the company. When things are good, you're really good. When they're bad, they're really bad. So I've had a chance to experience the good as well as the bad.
Definitely. So, what's your advice to somebody at this point? Do I buy right now or do I wait? Buy or not buy is the question. What's your advice on that?
So, what I'll tell you is that in any market, there is a deal to be had. I really do believe that. Markets do change. What I will say is this, and boy, you know, I don't want to be evasive, right? But I would say, no, you have to know what you're doing. This, like I mentioned a few minutes ago, that, you know, before the previous market and for a number of years, you know, it's like fishing in a barrel. You really could almost not catch a fish or come across a deal, or there were so many different ways you can make money. I think having full, complete information and just being, you know, informed. If you're a novice right now, partner yourself with people who know, people who've been there. For as many things as I've learned from my successes and my wins, and I've had a lot of them, I've learned far more from my failures or setbacks, if you will, you know, because it is only then when you are forced to deal with that pain point, you want to make that pain go away. And if you felt that pain, you don't ever want to feel that pain again. And so you always learn more from that.
So I know your bread and butter has been building, right? Kind of planted your flag with building. So for the builders that's in the room, what is your approach right now if a vacant lot falls across your lap? What does a deal look like today? How you underwriting it differently versus, you know, 3 years ago, pre-COVID?
So it's a moving target. It really is a moving target. If I can kind of detour a little bit on that and give you a little bit of background on this. When I first entered real estate, I entered with the mindset of mine. I wanted to be 100% owner of everything. And being 100% means that you'll do whatever, whether it's, acquiring a property with strictly debt, perhaps over leveraging, or doing any number of things because you have this feeling of it's all mine, it's 100% mine. And if it's the right type of deal and you're equipped, have enough resources, what have you, then that can be the case. I'll tell you a quick little story because I saw on the little foundation questionnaire, what is one of the biggest setbacks or pain point, or whatever. Basically, what mistakes have you made that you were trying to avoid or whatever, right? So in keeping with that same idea of mine, it'll all be me. I had the opportunity where I was offered a large sum of money to be able to fund as many deals basically as I could figure out and calculate, in running my numbers, right? And so I went on and, did the debt, type of thing with them, with certain payments that needed to be made. And what did lead to a lot of growth for me as far as me being able to develop my portfolio, I learned probably a couple of years in that I had made a mistake. Because when you take on a certain amount of debt, what becomes incumbent upon you is to operate and turn at a certain rate of velocity. And if anything happens where you cannot turn those deals quickly enough, right? It's one thing if your philosophy is to, I'm going to develop, I'm going to sell, develop, sell, develop, sell. Well, remember, as I told you earlier, I'm a whole kind of person. And so the cash flow coming from the assets wasn't really enough to service the structure of the debt that I put in place. So it was through this pain and this, oh shit, what now kind of thing that you began to search for answers. And so what that led me to was the understanding of proper deal structure. If you leave this night with not one thing else taken away from what I'm rambling about, understanding deal structure, probably the most important thing that you could come away knowing. Because what I learned was that trying to structure everything where I would own it all is not all the time the best answer. And if you want to go fast, go alone. If you want to go far, take people with you. And so I set out on a quest to learn better and different ways of structuring deals and sharing the wealth, because debt equals obligation. When you structure it differently to where there's perhaps, say, an equity partner, well, that's participation. It's a way of sharing risk and also sharing profits. But when we put deals together, let's face it, all of you guys are always thinking about, whoa, how much money I can make. But when you sit on the other side of the table and you're speaking to a lender, they're trying to figure out what the hell can go wrong. And so if you can structure your deals to cover the downside and the what can go wrong, then the upside will take care of itself.
And how different have the conversations been on the banker side, right? So a couple years ago, you get a lot in Gentilly, $20,000, you could throw something on there for $200,000, it'd be worth $400,000, and you projecting you could sell it within 3 months, right? So, but today,
Yeah.
you had a conversation with the bankers today, so now that same lot, let's call it in Lakeview, comes across 150,000, you know it's a $650,000 house, but what's the different questions or what's the different approaches and considerations the bankers are having with you now?
So the good thing is that because I do have a lot of skins on the wall, you know, my track record, my demonstrated ability to maneuver in and out of tough situations, that has served me well. Building relationships, right? I mean, in this business, and you don't go very far on your own. You are only as strong as the people you surround yourself with. You know, your lenders, you know, your realtor, whoever's running your jobs, if you're doing it, your GCs, and you know, just your team. You know, I was sharing with Emile that up until like 5:45, I was on the phone with my banker. I'm like, dude, let me get off the phone with you. I'm gonna be late for this meeting, man. I'm talking. And one of the things that he told me, you know, was like, look, man, you know, stay leveraged. And so what I can say is this, right? Selling, it's a tough market to really be, you know, that flipper right now, right? Yeah, houses are gonna sell. I mean, there's always gonna be houses that sell, but, you know, not as many. I mean, people are being ruled out or X'd out because the interest rate alone, right, is gonna raise their notes significantly, and they only make so much money, so the interest rate is gonna change, right? Whereas they were getting 3% and 2 point whatever or whatever, that's changing for some. Them making changes, and Betsy would be wanting to speak to how many deals maybe have been lost because of flooding. You know, they changed things, they changed the game on flooding insurance or whatever. Deals get lost because of that. And now I've already told you, Louisiana citizens, you know, so increase insurance premiums, increase interest rates, people want to buy, they desperately want, but they can't qualify. So you have people being picked off because of, you know, different things like that. So that's one thing. If you're that person who says, well, listen, I really like the idea of developing and building assets under management, right? Building a portfolio. What I'll tell you is learning the different types of leverage that are out there, right? There was something that was presented at one of the NOREA meetings back, a few years back, and it basically, the guys in the front of the room hold it up, you know, 4.5%, whatever percent, or 10%, and it was all different types of leverage. One was an interest-only loan, one was a, you know, 15-year, whatever, and another one was a 30-year, and so it's like, all right, which one is the best one? You know, and I think people were guessing, but a lot of people really didn't know. There are so many different sets of metrics that you can use when making a decision on what type of loan, the proper amount of leverage, and all of that stuff to go in. And a lot of us really do. We approach it haphazardly, and I'll raise my hand saying at some point in time in my investment cycle, I was no different. But I educated myself on certain terms like loan constant, break-even ratios, of course, you know, debt service coverage ratios, and all of these things, because these are the things that will keep you out of trouble. I've spoken to people very experienced, very knowledgeable, who just flat out say, oh, I'll get as much money as I can on a property. I'm like, maybe not, right? You might also be the one getting in trouble at some point, you know? But learning the different types of leverage, interest only, you know, stretching out the amortization periods as long as you can, because if you're buying and you're holding a cash flowing property, then the most important thing in that is the cash flow from the property. So the most important component to that is the cash flow of the property, right? And I would step into loans early on in my career where going to a community bank, typically, you know, they want to amortize it perhaps over 15 years or 20 years. And I recently, or at some point, switched more over to something that was more of a 30-year product, right? Because at first I would say, well, I want to get it paid off and paid down and get it unencumbered. that really, that's, so what I would do is I would go with the community bank loan, try and work towards getting the property unencumbered. But then what happens is this: I learned that the lender gets you to pay it down as long as whether you owe 75% on the property or you owe 25% on the property. Guess what? When you pay it down, all you're doing is shifting more of the risk to yourself. They've got a property that if anything happens and there's a hiccup, they come get the property for 25% owed on it, right? And so I started looking at different structures on my loans where it's more of an open-ended product, all right? And it's something very simple, something that a lot of us are aware of, but because I had a good relationship with my lender, I was able to put certain things in place on a percentage of my portfolio that was a first position, equity line of credit. And that is a commercial product that's not really going to be offered to very many people, all right, at all. I mean, Dave was around when I talked about it in theory or whatever, and I had to threaten pulling a couple of $1 million worth of assets away from the bank. I pulled about, I remember the day that my banker told me no, and I really want to do this. No, we'll never do that. And I think I ended up pulling about $1.5 million worth of loans away from him. And I went back, about a month later. I said, man, I really would like to do this. Hey, man, let's talk. I think we can work it out. Right? So the reason why, I'll share this with you, and again, good luck, because there are ways to go about doing it, right? I did it in the form of a commercial type of environment, but there are ways that you can do it personally, and there are lenders that I know of that do it out there. But the difference between an amortized product and what I'm describing in a first position line of credit, it's an open-ended product, right? So it means that you can have money come in, right? Whether it's 10,000, 20,000, 50, 100, whatever's on in. And what I would do is take that amount of money rather than letting it sit in my checking account, where all it does is enhance the fractional reserve lending model of the bank. What I'm able to do is put that on my line of credit. And so in an environment like right now that we're in, where you're maybe a point above prime or 1 point something above prime, well, if that rate is 8.5%, if I put $100,000 on that line of credit, I'm saving myself or making 8.5%, right? So it's about, what I learned was this: it's not just about real estate. If I were to survey you guys here today and say, man, how many of you guys love real estate? Come on, raise your hand. Do y'all love real estate? Do y'all love real estate? Lying y'all asses off. You don't love real estate. You love what real estate can do for you. If we're being totally honest. No, don't get me wrong. I love creating something from nothing. I can tell the stories of vacant, weeded up lots and an eyesore to the block, and go point to my 3 beautiful developments that I just finished worth 1 point whatever million. That's great. I've put assets in place that I now need to begin performing for me. So it's really not about real estate. It's an asset game. We all are talking about assets that we want to produce money for us. If it's a short-term investment, right, like a trade, you go develop the asset, you sell it, you take the money off the table. And then you're looking for your next trade, your next deal, your next real estate deal. If it's a long-term hold and I believe in this area, well, then okay, how can I go on and make money along the way? But it's all about assets under management. I love what real estate can do for me. I do not like having the conversation that I had with one of my tenants today who's complaining about my property manager, or the other one who's blowing up my phone about her toilet seat needed to be changed. There's nothing that I like about that, but some of it's baked into the cake.
What do you think do you think your banker meant when he said stay leveraged?
Huh. Well, that's what it is, right? So people start looking at a rising environment of interest rates, and so people are like, well, should I go down and pay down my mortgage? Should I do this? And it would probably be almost conversation for more like a weekend meetup where we really start breaking it down and get on the board and start really, penciling it out, because I really am that kind of a numbers kind of nerd. David's been on the receiving end of a few of those conversations, like, oh shit, I didn't know it was gonna be this long. He goes get the legal pad and we start writing. But it, remaining leveraged protects you from inflation. And it's a very complex, I almost can't really get into it. But remaining leveraged actually protects you from inflation. And if the focus were to continue to pay and pay down your mortgage, like what I described in a closed-end vehicle or instrument, you have debt equity sitting there within your mortgage that the only way you access, it's why people take and they recognize it and say, oh, I'm gonna refinance my home. Well, you refinance your home, it's gonna cost you a point or two, and there's closing costs and new appraisals, and then a whole new title insurance policy. It's gonna cost you, what, $5, $10, whatever $1,000 to go access whatever that equity is. But if you do a line of credit, you can remain as leveraged or deleveraged, or whatever level of leverage that you see fit. If you're flush with cash and you're liquid, put it on a line of credit, it's working for you. You find the deal that's the right one to pull the trigger on, then you pull it off of that line. It can go in, it can go out. In, out, open-ended. Now, say you have $50,000, okay? Emile has a closed-end product. He said, man, I just flipped this deal, man. I'm going to try and pay down my mortgage. He throw that $50,000 on that mortgage. What you got to do to get that $50,000 out, Emile? You got to refinance it. Mike says, I'm going to go put that $50,000 on this line of credit. Now a deal comes my way. What do? I just draw on a line of credit and write a check and pull it out. You have flexibility. You can maneuver better. There's so many different options that you have, right? And so I don't say that you have to have every property that you own on an open-ended type of mortgage. You just have to have maybe enough that you feel you might need to be able to access for walking around money to kind of maneuver, in this real estate game.
And for the people that say I'm a change strategist, right? Because you have your hands in multi-family, short-term rentals. Any one of those protected against what we're going through right now?
So here's the good and bad, right? So I do have some closed-end mortgages that I'm glad that I locked in when I locked in. That's me locking in at a 5% interest rate. The specific conversation that my banker had with me was not locking into an amortized product in today's environment. Because what you're doing is you're locking in at what we know are some higher interest rates, right? So he, specifically, and my banker moved from the current bank where my product is right now to a different bank, and so I'm gonna be pulling it on over. And whereas before, he was trying to talk me out of it. He's like, dude, don't you go on no amortized product. Don't you do that. We're gonna leave you on this right now, and when things get better, then if you wanna lock in, we can lock in, Because all you're doing is locking into something that you just know is not the best interest rate, but that's where we are right now. And it's not going to change. And so if you have options, listen, if you're gonna lock in at something that's not an ideal interest rate, then just look at what your step down, prepayment kind of penalties, because most of these loans that you're gonna get, right, there's gonna be like a 5, 4, 3, 2, 1, like for every year, there's gonna reduce in what you have to pay in sort of a penalty if you wanna refinance. Chances are in the next couple of years, it's not going to be anything so great that you're going to want to come out and refinance for. But at some point, that may happen, right? So there's just so many things to look at. But he said, you know, just taking very much care in locking in at what you already know or feel would be just an uncomfortably high, you know, type of interest rate. You know, just keep and maintain as much, you know, kind of ability to get in and out of that, you know, if you can. And again, I'm just gonna say, you guys can research, and I'll be more than happy to kind of share with you, you know, after the fact, just certain options for that, more of that open-end product that I'm speaking of.
Yeah. So for the guys that are on the market right now, what's your philosophy on reducing prices? So should we hold out? Should we reduce and get rid of the asset? What's your approach now with reducing?
So what I'm gonna go to, I went back and saw the video that you kind of put out there earlier today, and you said something that struck a nerve or whatever, right? When we're putting these deals together, let's be honest, most of us are really looking to try and see where we're gonna get this money from, how we're gonna have enough just to get through the budget of rent, of rehab and renovation and all that stuff. And if we're holding the property, we don't ever pay attention to reserves, right? And so I took a few on the chin this year just because of some other stuff. Some of it was in real estate. Some of me was playing around with damn cryptocurrency. I mean, but anyway, you know, the next big whatever, right? Anyway, so I took a few L's this past year, but what it did, it really kind of dinged me on some of the reserves. Reserves are how we address or adequately address risk. It's how we try and mitigate it, right? It's how we feel comfortable when the roof gets torn off of your apartment building. It's how we are comfortable when the crazy mechanical building inspector holds you up for an extra month on getting your certificate of occupancy. I speak from experience, obviously, but you know, because that's your holding cost that you didn't even plan for, right? And so as much a part of how we put our numbers together is having adequate and even more than adequate reserves. I'll tell you personally, because of some things that have occurred over the past year, I'm probably going to take a couple of my holding or assets that have a couple of years on them or something like that, and you know, although maybe I won't get top dollar for it, I'm probably at some point gonna maybe sell one or two, not for the point of, you know, going, you know, buy a boat or something like that, but just to go on and make certain that my reserves are where I'm accustomed to them being, right? So this is a time where you just have to be a little bit more aware, guys. Definitely, you know how to say look both ways before you cross the street? You might want to look about 3, 4, 5, 6 times, all right? And again, it's just, I'm gonna just kind of speak it to be real, right? There are deals to be had. There are ways you can put it. Rather than going alone on it, perhaps consider a partner that complements you. You know, whatever your superpower is, complement it with his or her superpower is, and you guys just make this dynamic duo, or however you put it together, to where the risk can perhaps, you know, be shared. Of course, trying to find something on sale is always a good deal. I know Steve's real good at finding things on sale or whatever, you know, so, you know, when you can do that, right? I mean, you know, you can hit that number and be creative with how you structure it, right? I mean, look, seller financing and all the things that we speak of, just find a way, you know, how you can put these things together to where maybe you're not at the mercy of the lenders out there. Maybe you're speaking more to a person that you found their pain point and you're brokering a win-win situation. You know, they're trying to get rid of the property. You have a strategy, you've got reserves, you've got a unique skill set and people that you run with that can improve this property. And they're fine with being patient on maybe, you know, getting the rest of their money, whatever it is, right? I mean, but, you know, that comes with just creativity and just doing deals and learning. Making the mistakes
and just speaking with people, you know, who've been there.
So you pro reducing prices or against reducing prices? I'm talking on the market, you know, right now you just threw a product up, $320, and now those days on market just folding, just ripping pages off the calendar. But there's still an environment that you gotta maintain because you might have 3 other lots in that same neighborhood, so.
Look, man,
That's my
I
question.
never really want to see prices go down. I'm be honest with you, right? Prices going down doesn't favor me. Of course, you want the price to be low when you're buying, but when you're selling, we all want it to be high, right? But if you're in this game, right? See, and here's the thing why my philosophy is assets under management. In an inflationary environment, having assets, a whole heap and load of them, that benefits you. That benefits you. See, because it puts you on a different side of the equation, right? This whole thing can be, I look at this and I break it down to really things being mathematical. I think a lot of things can be solved through math, right? So there's the consumer side, there's the producer side, and all this stuff, right? So if you're on the producer side and all that stuff, things go up. I mean, really, what are you doing, right? I want you to think about it. If you're on the producer side, if you're McDonald's and the price of beef or soy or whatever went on up or whatever, all you do is increase the price of the hamburger or the French fry or the Coke or whatever it is to reach your profit margins, right? What are we as the owner of several assets going to do, right? It's not rocket science, but I mean, rents are going to go up because they have to. Now, there's a point to where the rent you just can't raise it to any price. It's got to be in line with market. But basically, if you're on the right side of the equation and you own all these assets, you know, basically you're a go-between. The bank charges you more money for your loan. You know, your insurance, you know, provider increases your premium. You're going to increase your rent. At the end of the day, the consumer, i.e. the renter, is the one who bears the brunt of that, right? So in our whole everyday world, right, we're both consumers. We're definitely consumers, right? We go to the grocery, we consume electricity, we all have bills. We are consumers, right? But how you pay for a cup of coffee can mean all the difference in the world, right? I mean, how you buy a vehicle, right? Are you gonna go and pay for it all cash? Are you gonna go and get an auto loan at, you know, 3, 4, whatever %? Or do you have some other type of way of paying it, you know, like a permanent life insurance policy that you funded that's growing in the market and you can borrow against it and you're borrowing from yourself, and when you pay yourself back, you're making money. You're now becoming the bank. We reach off into a whole different, you know, conversation when we talk about, you know, a banker's mindset, you know, versus, you know, a consumer's mindset. The banker always wins, right? And so I've learned different things in my experiences that real estate, it's a vehicle. I like very much what it can do for me, but for me, it's all about finance. It's about making the numbers work for me and developing assets, acquiring assets. And if it happens to be real estate and it's a good deal, great. If it's some other type of asset, we'll find too. That's where diversification comes in, you know? But to answer your question, because I just love speaking, I never really want to see prices go down. Of course, when things go up too quickly and the market gets overheated, which we probably experienced a little bit of, maybe, you know, but not as bad as certain areas. I mean, not as bad as certain areas. We're not the worst, trust me. So, like anything else, the fattest hog gets slaughtered, right? In those markets where it was a really race to the top, there's going to be a greater correction. I think, and I would, you know, defer to someone like Betsy or other realtors in here who really are seeing it, you know, in the trenches. It's probably maybe a little bit of correction. I don't think anything's fallen off so much. You know, but again, you go from it being a seller's market to a buyer's market, well then, you know, there's gonna be some degree of correction. So I think we're gonna see, you know, what the new normal is. I think we're starting to see some signs of it. I think it's going to continue to reveal itself as the year of 2023 goes on.
Yeah. So you talk about from the builder's perspective how the conditions kind of impact. So if I'm a wholesaler right now, how do these conditions affect me, right? So if the mindset is, well, I'll just buy properties cheaper, there's still a gap with that mindset. What's your, because you got to buy from wholesalers, right? So what's your advice to a person on the front lines as a wholesaler that has to hand it off to you the way things are right now, in your opinion?
I think for anyone on the wholesale side, you have to really be in tune with what the market is doing, right? I don't know how many, and listen, I've built my business off of very fine relationships with wholesalers, right? I am not the best person to go and source deals. I have wholesale deals by accident, right? I bought it, oh shoot, I don't want it, and I just happen to sell it for, I don't know, like 5,000 more or something. Change my mind on it and just happen to sell it for more. I am not a wholesaler, have no desire to be. However, I know people who have built successful wholesale businesses and they do quite well, right? It disturbs me, even to the point of irks me, when the wholesaler comes to me, you don't have an adequate grasp of what this number is. You're throwing numbers out there and just trying to get somebody to buy. And I'll tell them in a heartbeat, look, if we develop a relationship, I could very well be a volume buyer from you. I do not guarantee to give you the highest price, but I will buy more from you. Because on where I sit, when I buy this property from you and I buy it for too much, you're gone. You're going to spend your money and say, hoo-hoo, hee-hee, but the rehabber, the renovator, the builder, we're left to hold that bag with whatever decision we made, good, bad, or other, right? And so what you're gonna see, because one thing I explained to Emile when we kind of, chopped it up maybe like, a few days back, a week ago, was that the way things are changing, right? They're like, just for example, these certain set of projects that I just finished. I went into it. These projects started like, I don't know, 7-8 months ago, something like that, just development of 3, real nice sized properties. And the feds raised interest rates multiple times while the project was going on. So not only that, I'll just share with you, there was I was expecting to be able to kind of maybe, do a little bit of short-term rental with it. Well, thank you, City of New Orleans. I don't know that that's really gonna happen or whatever. So the whole exit strategy in a matter of less than a year just totally flipped. So what I learned when I was putting deals together was develop multiple exit strategies. That would be the other thing too, right? Because if you went in, more commonly what would happen is a person like, oh, I'm gonna sell this house. And then what happens if it doesn't sell? Can you put a tenant, some type of person, individual in there that can service the debt, right? And so I would always put deals together to where if it didn't sell, I would be okay holding the property. Well, you step out there and you build a really expensive home, high-end home, it's hard to really find a tenant that's gonna cash flow that type of property. If you really go all in and sink a whole lot of money into this real nice, lavish experience of a vacation or short-term rental, really hard, to have a market rate tenant that's gonna go on and kind of cash flow it or whatever. So I'll tell you some of the best things that has happened for me is my willingness to take risk, right? If you're unwilling to take a risk, then you're basically saying you're content having what you got, right? So it's kind of, if you're not unwilling to take the risk, from where I sit, it's a losing proposition. Take risk, but let it be more measured. Let it be more calculated. Really know your numbers. Kind of like they say, measure twice, cut once. Same thing. Review those numbers ad nauseum. And I always, talk to those who kind of have the analysis paralysis. Don't be that person, but you just have to really just understand, have the right conversations with your bankers and other people who are really in the field and really know what you're doing, and then run those numbers. And again, know your metrics. I talk about break-even ratios, debt service coverage, and other things like that. You know, loan constants. You know, some of these may sound vaguely familiar. Some of you, like, I don't know what the guy's talking about. You know,
And
you need to know what those things are.
What tools you using to measure those? Is it a spreadsheet? Is it a roundtable conversation with experts on each one of those metrics? So what is your decision-making wheel look like?
Yeah, no, I've received a whole lot of education, Emile, along the way. And I know they got people in this room that are familiar with the name, but there's a guy who changed my life. I mean, 150, 1,000%, right? When I talked about deal structure versus just a total debt kind of instrument, but George Anton, you know, and I know some of you guys know the name. I know, yeah, he is the truth. He is a beast. Because he doesn't come trying to sell some sort of a real estate program. He doesn't, you know, whatever. He just looks at it purely from numbers and understanding assets, understanding the characteristics of assets, understanding the characteristics of certain types of leverage. And when I say leverage, I mean loans, right? I mean, you know, we use these things, you know, interchangeably, right? So knowing how much leverage is too much leverage. You know, if you don't know what that is, you need to get to a place where you can better understand that. So I continually, constantly educate myself. I do the brain damage, you know, so that I can continue to evolve and grow. One of the things that, you know, those foundational questions that you asked, are you driven more by fear or desire? I'm driven more by fear.
Fear what?
Fear. Well, even when I am or have been at my most successful point, high point, right? I never feel as though tomorrow is guaranteed, right? I know what it's like to be on top of the world, at least in my mind, and I know what it's like to have the world on top of me. And so I know that if I'm not careful, that can always change in an instant. You have to have a healthy respect for what can happen. Fear is healthy, depending on how you process it. And what I mean by that is this. If you're staring fear and it's in the face and it's in front of you and it keeps you from moving forward, that's maybe not a good thing. But if you can find a way to package it, analyze, become more solution oriented, let that fear move behind you and let it push you forward. I can't ever say there's a time where I'm not worried about what if and what can happen. Let it motivate you to get to the point where you can sleep well at night because you have enough reserves. You've addressed the things as best you can, at least in the time we're in now, and working towards certain goals, right? I've got big, crazy goals of trying to be able to have something, you know, like 100 million of assets under management. I don't know if I'll ever reach that, but that's one of my big, hairy, audacious type goals. And I'm gonna, you know, I'm still got enough left, you know, not so long in the tooth where I don't think that I can't achieve it. I don't reach it, I don't have to reach that to really do okay and take care, you know, of myself, right? That keeps me, you know, going. Focus on building reserves. Sometimes reserves sit there and it's nice and plentiful. Sometimes it gets a little shy because you've taken a few on the chin. Well, that's what they're there for, right? So I'm in rebuild, increase, improve reserve mode to match today's climate and where we are, right? But I think it's important, you know, if you're not afraid of anything, that's good, but I don't know if it's good, right? I mean, that's fine, right? I mean, when I wasn't afraid of anything, I was kind of young and dumb and didn't know better. Ignorance is bliss. But when you've kind of been knocked down enough and you've kind of been hit with some hard Mike Tyson type right hands or whatever, you know what taking a very hard blow can result in. It could take you out of the game if you're not careful, right? And so I'm not here to kind of say, oh, be afraid, don't make the next step. All I'm saying is be aware. You know, just really be as certain as you can. You know, always be trying to get something for the best price, but just think about what plan A is, try and have a backup plan B, or you need to have a backup plan B and even a plan C. And that feels a little bit better depending on where you are and even how comfortable you are. You know, having a partner, you know, that really it can make a difference.
So where you think we headed at this point? So last year, somebody would have asked you if the Fed would have went up so many times, they probably would have thought you were lying, and it happened. So what's your opinion on moving forward what the rest of this year could look like for the market?
I think we're in a year where we're going to be uncomfortable. We're going to be uncomfortable. I don't think there's any real way around it. We're going to be uncomfortable from the standpoint of what we've known to be normal, what we once looked at as normal. We're going to be uncomfortable. And it's one thing when change happens, when it's more insidious and gradual, but it's happened so quickly that people have not had enough time to adjust, right? It's almost like, you know, you get hit by, you know, a hard shot, and if you give it enough time, you adjust, you kind of regain your legs, and you make the correction. When you hit with one, and then you hit with another one, it's like, whoa, you're just trying to gather yourself. And I think that's where we are. We're just having to still try and process some of this, right? Because a lot of us, right, we're smart. Most people have the capacity to really figure it out if given enough time, right? Take the time to educate themselves, speak with the right people, gain the knowledge, all that stuff. But we just kind of need the time to kind of figure it out and come up with the solution. But sometimes it comes at you so quickly, and depending on at what space you're playing in, it's happening on multiple fronts. You know, multiple projects you have going while all of this is happening. It's one thing if you got one project going, but if you got like 3, 4, 5, 6 going at one time, now it's happening all in tandem. That's where things like reserves and all these other things that buffer the pain come into play. And most of us in here, we talk about, look, I've been through every type of training imaginable, where, you know, and masterminds where we talk about building, you know, scaling up and doing this and doing that. If I'm being totally honest, most of us here have a mom and pop kind of operation where a relative, a close friend, or just this one person that we've tied in, maybe a virtual assistant or something like that, we got a little bit fancier, but we're really only a half a person, one person away from it being almost a 1 or 2 person show. That's just my experiences. There are very few exceptions to that, you know? And so you're having to be the deal maker, the person to coordinate the project getting done and do this and do that. We're all wearing multiple hats. And when you have a lot of fires being put out in several areas, you can get overwhelmed, right? And so that's what I'm saying. Just you know, it might be the time to just slow down just a bit, right? Where you can just organize and collect your thoughts and figure out what the right moves are to make. I believe that we're gonna figure it out. I just think it's gonna take just a little bit of time to just feel better about it, right? But I do believe, to answer your question, I think 2023 is gonna be a different kind of year for us. I think it's gonna stabilize as we get midpoint, maybe third quarter. I don't see any real reduction in interest rates coming this year. I think once the feds and those powers that be feel better about where inflation is and get some more numbers back, there might be a little give as we roll in or about to roll into 2024.
So you're saying you have to speculate a little bit when you run your numbers
Yeah,
on your what if analysis?
yeah, it's like anything else. You stress test. You kind of stress test it, right? I mean, you know, what if they had this kind of vacancy? What if the rent was this? Or what if the feds raised interest another 50 basis points or whatever? At what point is this deal a deal or not a deal, right? So if you just if it only works with this one scenario working and there's no room for anything going wrong, I'm gonna tell you, that's not the deal for you. That's not a deal you should probably be doing. That's the way I worked the scenario back when I spoke about Carlton Sheets, right? Oh, the rent's up, Katrina, you know, they were getting people, you know, all these high rents and everything is gonna work. Then shortly they started decreasing the rents because it was all federally, you know, funded, and then real estate prices tanked because of the market and this and all the whatever lending and all that stuff. I had one scenario where it worked. And when that changed, I had my you know what handed to me. So it's a different time, but all I'm saying is you can't just have that one scenario where it works, and if it doesn't, you're in trouble, because I can almost tell you with certainty that's a sure recipe for disaster. Don't do it. Don't do it.
All right, we're gonna take questions a little bit, but Mike, man, so what's your gap right now versus where you are versus where you want to be, and how can the room help out?
Oh man, well, you know, for me, I'm continuing to grow, you know, and you know, for me, like you already know by now, the name of the game for me is assets, right? You move assets, you know, assets come in, you move assets out. You know, I will tell you, when I first built my portfolio, a lot of it was built around single family homes. The characteristics of a single family home versus multifamily, whether it be a double or fourplex or apartment building, is different. The more doors you have associated with that property, it runs more like a business, right? Single family home, we know that the way it's valued off of appraisal is gonna be strictly, you know, kind of comps, market comps and stuff like that in recent sales. Multifamilies, the bigger you go with them, it's gonna be way more a function of income. So if you're smart about ways that you can increase the income on those properties, that's what's going to affect that property's, you know, valuation, right? So to get back to exactly more what you were asking, what I'm doing is I'm taking some of the lower gross income producing assets, probably gonna move a couple out to just address the area of reserves, which I'm now weighting and considering to be more important. As I develop more properties, I'm doing them not so much as a solo venture, but with capital partners that I feel as though I align with and make it a win-win situation. There are people that tell me all the time, Mike, I've got no desire to do what you do and deal with the stuff I see you deal with. I have a little bit of money, all right, and I just want to know that it's in good hands and that it's going to be making money. I want to own something, right? I like the idea of owning real estate or whatever, and so my job then becomes, let me do what I do. Let me develop this asset, brand new construction. Everybody likes new, right? And you've got about a 5 or whatever year run where the maintenance is very minimal and it's kind of like that honeymoon period, right? That's my business model, right? I've gotten lucky on the existing ones where, you know, minimal renovation was done, but I really prefer where there's a whole lot more renovation needing to be done, where I know that I've redone the plumbing, electrical, whatever, because a lot of times when you buy that just put lipstick on it kind of thing, you don't know what hidden problems you got. I've bought it both ways, and I've been, you know, digging under slabs and replacing the deteriorated, you know, drain line going to the sewer main or whatever, right? Thank you, you know, $8,000, $10,000 later that you didn't see coming. So when I build new, I know what I have, right? So that's what works for me. That's what I can say. So I'm looking to do things like doubles where possible. I've got this thing that's about going to work out for me because there's an affordability and affordable housing component, because the city's all about the buzz of that, where there'll be an affordability component to it, where I'm going to be able to build and develop a couple of fourplexes. And then I've got another property that I'm looking at that I can hopefully be able to build out, probably do the design of it this year, but probably more into next year, do like a 20-unit development or whatever. So that's what's on my radar, now or whatever. As far as, who can help me, money guys, and I've never heard anybody in the real estate industry say, I got too much money. I've never heard it. The day I hear that, I'm like, oh Lord, it's no such thing, right? Because you may have enough money for the project that you're wanting to do, but depending on if you're trying to, go up, depending on where you are, $500,000 could be a lot of money for you. And depending on where you are, $5 million may not be enough. It's all relative, right? It depends on where you are, what you're trying to accomplish, and where you want to be. For me, having good lending partners, sometimes those who can be a part when the deal is a little bit hairy, right? Because I think there'll be some deals to be had, but what can mitigate it is just somebody who's got the experience and the know-how to kind of, get through it. Some of the obstacles I've had at some point in time is being one of the earlier ones to go into a market. Some of you guys may not even know, I was one of the first developers, builders, to even go into Gentilly, when Gentilly wasn't even what it is. I was selling my first house, very first house I sold, believe this, was less than $200,000. I know Betsy remembers, right? Yeah. And I think, we got up to, I don't know where we're at, but, it went to like, twos or whatever, and then, people started flooding in because they saw that something worked, and next thing you know, 400,000, and like, holy crap, But I was one of the ones who got it started. I got that whole thing kind of going, or one of the ones that got it started, right? And so I am what you call, or historically I've been what people term as a contrarian investor, where you go into an area that has some ills. It's not all perfect, but you have enough vision to where you think you know what it's going to be. Because if you go in there when it's there, the price point in which you pay for it is going to be totally different. And so a number of properties that I own, I was able to get when it really wasn't advantageous being there. But if you can just sit tight and hold, for a couple of years, you'll reap the benefits of that. Because as other developers go in there after, they're going to pay more for it. Their costs are higher. So now the cost of that developed asset is going to be more. So I've got assets that, maybe I was like, 200 all in, and now it appraises for maybe, north of $400,000, right? So I don't or won't sell that, because in theory, if it's worth that now, given enough time, it'll only be worth more. A lot of where I develop and build are in opportunity zones, right? So if any of you are familiar with that, you get a certain benefit after holding the asset for 5 years. You get another level of benefit if you hold it for 7, but if you hold it for 10 years, whatever your basis is, your cost basis is, it then goes up to market rate, right? So if you were to have 250 in on something that appraised them for 300 and you flip it, you're gonna be paying taxes on that 50K. Hold that same asset for 10 years, let it ride it on up to 600,000, just for a round number, that 250 now goes up to market rate of 600 and you pay 0 on the taxes, right? It's not about how much money you make, it's about how much money you can keep. And again, finances. And one of the ways that you become wealthy is by being able to manage these other private partners that don't have anything to do with your success. And one of those persons with the federal government, Uncle Sam. So it's just tax mitigating or strategies, and Opportunity Zone I've found to be something that I utilize and I'm using, for my purposes.
Last question before we take audience questions. So I know another one of those big costs in these developments is construction. So what has labor looked like for you most recently versus in the past, and controlling those costs to make this whole creative structure work to get these deals, to stay creative?
Yeah, so that is something that it's moving, right? I mean, right now, because things are costing more, people are needing to try and earn more. Mid-project. So the way I'm kind of built, just to kind of add a little bit more color to it, I work with GCs, but it's more to kind of just be there as a, be there if I need you kind of thing, but I really run my crew, my projects, right? I've got my subs that I deal with that I've worked with for the most part for years. And so what happened mid-project, on the most recent development is they came to me, when they all kind of say, hey, Michael, can we talk to you? And they all there standing in front of you, like all 10. I'm like, okay, this can't be good. And so like, look, we was wanting to talk to you about more money or this or that or whatever, right? Or I see it in the form of the sub that I've used, on my siding or something like that, I'm thinking 2020 prices, and I'm like, hey man, wait a minute, I paid you $4,000 when we did this. I'm like, yeah, no, not anymore. I'm like, damn. So I've seen prices go up on the labor charges, with some of my subs. With the crew that I'm more responsible for, keeping my job moving, I've had to give them increases. I've seen that, and definitely we all know, with materials and lumber and all these prices had been. Now, I've not seen any easing with stuff like wire for electrical type stuff. I've not seen any break with anything like HVAC and that kind of stuff. More recently, maybe within the past month or two, there has been a bit of a drop on the commodity side with lumber. So that makes me feel good, because I was getting lumber packages that were, approaching almost 100K on a structure. And I'm like, what the hell? And I got something back for the same similar type structure, and it's down to like maybe, 60, 65. So that's significant, because the value, it doesn't change the valuation, whether your lumber package costs you 90 or 65. The valuation is the valuation, right? It just means that it costs you more to build. With that being stated, because of the environment, and I believe there are not being as many projects that are going to be taking place compared to what it had been, I think that some of these crews and people that are capable of doing the work, where they were more, here's my price, and it's up and it's high. When people start slowing down and crews aren't working, these people lose their guys, and you'll be willing to, you may be able to have a different conversation on being able to get maybe some better pricing, just because by far and large you're not going to be as busy. Like it was before, they wouldn't care if they took your job or not, because they got another 5, 10 people waiting. It's like the whole, supply and demand, kind of thing. So if the jobs are slowing down, there is a possibility that we could maybe be able to, especially if they think there's going to be more repeat work, that you might be able to negotiate somewhat better price on there. But I would say the only real thing that I've seen break so far that I'm encouraged about is maybe at this point the price of lumber is going to come down, and so that has me feel good as I go into these next couple of projects.
We're going to take audience questions, and Steve will come up with needs and wants, and we also have a very, very, very special announcement. something big that's coming up in the very, very near future. But right now, questions from the audience.
Sure.
So the question was, how do you increase income on the properties that you currently have? Yeah, how you increase income?
So clearly, if we're talking about an apartment complex, there are ways, again, when we talk about coin laundry, it could be a case of providing special parking, covered parking, or things, of that sort. More realistically, the way that you're gonna do it is through really making your product kind of stand out from another. I know that Nelson, who spoke here back, whatever, one of the reasons why he was able to sell his homes, maybe better while other ones sat, is because he did a better job with the finishes. What I found with the rental side is that there's people that finish properties with a real cheap rental grade. And don't get me wrong, people will rent it. But by me making or creating some nicer finishes, right? I don't think that anybody really does Formica countertops anymore. I mean, I'm certain that there are some, but I always used granite and things like that because not only, was it, just more attractive, but it hardened the unit and just made it more durable for what some of these tenants can do to properties, right? But by me putting a little bit more into it, I found that if there was a rental range, that I could be at the upper end of that range. And one philosophy that I always had when doing my rentals was that, or anything, I did not want to have to apologize for why this was less than. And if you spend, and I only want to spend the money one time. I hate going in and having to go do upgrades and repairs, whatever. But if you spend the money, there's one time that we're willing to spend that money when we're putting that property together. And if you go on and put that money right there the first time, then you'll get a higher rent. They will appreciate it, and then at that point it becomes tenant, management. Other things, it just kind of that I'm playing with is going to be probably since something like short-term rentals and all that stuff is kind of in flux or whatever, and people's coins are limited. I'm really playing around with doing a bit more furnished type rentals where I can increase the price of the rent, because if someone, because of either credit, finances, or circumstances, can't really go get furniture because they're newer in the game, they're not coming with furniture, I can go down and charge $100, $200 more a month at least, on rent that if it's all furnished and done for them, so those are some other things that I'm actually playing with as well. We provide utilities maybe, but that's a hit or miss with sewage and water board charges and rising energy. So I'm not advocating that, but it's things you can do your numbers and see if it's beneficial.
Next question. The question is to build your reserves up. Which property types are you getting rid of, and why are you choosing those?
So when speaking with the banker, one of the things that they will have you do is fill out your financial statement, and they'll do an assessment of how much income you have coming in. So if I have a 3-bedroom home that for me currently rents for right around $1,500 to $1,600 a month, I'm more willing to sacrifice that as opposed to a double that may bring in, 2x or 2 point something x, right? Remember, for me, I'm looking at top line numbers. So if that single family home appraises for $250, but I've got this other one that's appraising for $4.25, I'm gonna hold on to the $4.25, producing 2 point whatever X income, because that helps my top line number as far as assets under management. As it grows, if I apply a metric of, someone could probably Google and look up whatever historically the growth, appreciation of real estate in New Orleans is historically. It's probably something just under 4%, probably like 3.9 or something like that. See, because when I talk about assets, assets are only divided into two categories. I don't know if you guys really knew that, right? It's either growth or income producing. It's really just that simple. And so we look at real estate as one of those rare, or one that falls in that category where it can be both, right? We expect it to appreciate, so we expect it to grow, but it can also be income producing, obviously, if it's structured the right way and with the right amount of leverage, right? And so selling something that's slightly lower price, I'm not giving as much of that, the value under management, and I can ride that wave of growth with a higher priced asset. So that's why I choose that, though. It's a good question, though.
Next question. The question is on structure with your partnerships, or are you structuring LLCs for each partnership, or what does the structure look like for each partnership?
So there are so many different ways that can be structured. I'll just say that. I've sat together to try and formulate my model, probably much to Dave's chagrin, But what I've learned for me is that one of my superpowers, right? Some people can go get money. Some people can't. Some people have a track record. Some people don't. I'm fortunate in the sense that I've been able to build a balance sheet that makes most any lender comfortable with me, depending on what size deal I'm bringing to them. I'm fortunate enough that I can run a whole project and see it through. I know my way around any number of things that can go wrong with it. And so I solve a lot of problems or check a number of the boxes for a number of people who are wanting to get in and just are willing or looking to trust their money with someone, right? So to kind of address more of the question, what I've found for me is I've come up with a way to where the risk of getting the loan and everything that goes on with it is all on me. There's a responsibility to where if I don't perform, that person gets their money back. There's an obligation. Remember I talked about debt, I talked about equity. So until I perform, until I do what I'm supposed to do, it's nothing but obligation, 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 right? I perform. I get the project to the finish line. And then and only then, once it's developed, I secure the permanent financing. We then talk about an LLC structure where there's an equity split and there's also a split of cash flow. And what I'll tell you is that what governs how I put those deals together, it really is just kind of knowing what that person is looking for, right? If I'm speaking with someone and their expectations and what they want is too much, then maybe they're not the right person for me. And although you have money, I'm gonna tell you, I'm not gonna feel good about this because, I'm not getting what I need out the deal, right? If you're gonna get it all, I'm doing all the work, see, because normally you go on to do the deal and you get some upfront money or whatever like that, and there could be ways to work it. You could work it out with some upfront money. Typically in my deals, I'm not getting any real upfront money, but in exchange for not getting any upfront money, I'll come away with a larger equity percentage, but maybe a more liberal cash flow, split of cash flow, to where they're gonna get that nice enough return, that cash on cash return on their money. See, because equity is good and growth, but most of us, our vision is only about this far, right? We just wanna know how we did that quarter, that year, and so I just try and give nice enough cash on cash returns, to my capital partners, and also on top of that additional piece, that equity piece as well, that makes them feel good, and they'll appreciate me 5 or whatever number of years down the road.
All right, well, Mike, man, we appreciate you. Everybody give Mike a hand clap again for showing us.